Every major recession in modern history transferred an almost incomprehensible amount of wealth, not destroyed it, transferred it, from one group of people to another. The 2008 crash made more new millionaires than almost any bull market before it. The same will happen next time. By the end of this video, you will understand exactly why that transfer happens, who receives it, and what you need to do right now to make sure you are standing on the right side of that line when it does. Here's what most people actually experience during a recession. The layoff notice comes first. Then the savings start bleeding out week by week to cover rent, groceries, and car payments. The stock portfolio they spent years building drops 40% in 3 months. Fear sets in so deep that even when the market starts recovering, they are too paralyzed to act. They sell at the bottom and buy again near the top. They come out the other side poorer, more anxious, and convinced the whole system is rigged against them. While that is happening to most people, something completely different is happening to a specific group. During the 2008 crash, residential real estate in cities like Las Vegas, Phoenix, and Miami dropped 60%. Investors with liquidity bought those same properties for pennies on the dollar. Entire apartment blocks, shopping centers, distressed business loans. By 2015, many of those same assets had tripled in value. The wealth did not vanish. It moved. It moved from the unprepared to the prepared. That is not a conspiracy. That is the mechanical reality of how market cycles work. The most common response to economic fear is to do nothing, or worse, to hoard cash. People pull money out of markets, stuff it into savings accounts, earning 1%, and wait for stability before acting. It feels responsible. It feels safe. But here's why it fails completely. Inflation erodes that cash while they wait. Opportunity windows in distressed assets are measured in months, not years. And by the time the news confirms that the recovery is real, every smart buyer has already moved on. Waiting for certainty in a recession is the single most expensive mistake a person can make. There is a reason this pattern repeats every single cycle, and almost nobody talks about it openly. It is not about intelligence. It is not about having more money to start with. Some of the people who profited most from the 2008 crash started with less than $100,000. The difference was not their bank account. It was the mental model they were operating from. They were not reacting to the recession. They had already decided, years before it hit, exactly what they would do when it arrived. That pre-decision is the foundation everything else is built on. Here's the core mechanism. Economies move in cycles: expansion, peak, contraction, trough, recovery. This is not theory. This has happened in virtually every major economy for over 200 years. During expansion, asset prices rise beyond their fundamental value. Debt accumulates. Risk is underpriced. When contraction arrives, panic forces mass selling, regardless of actual asset quality. Prices detach from value in the opposite direction. The person who understands this cycle is not surprised by the crash. They have been preparing for it the same way a farmer prepares for winter. Not with fear, but with a calendar. Look at the behavioral data. During the 2008 crash, retail investors, average people, pulled a net $150 billion out of equity mutual funds at the absolute bottom of the market. Institutional investors and high net worth individuals were buying aggressively at the same time. Between 2009 and 2012, Warren Buffett deployed over $20 billion into distressed assets. He was not smarter than everyone else in that moment. He was simply executing a plan he had already made. The data shows this same pattern in 1987, in 2001, in 2020. Every single time, the crowd sells the bottom. Every single time, the prepared buy it. The difference in mindset is staggering when you put it side by side. The average person during a recession asks, "How do I protect what I have?" The wealth-building person asks, "What is now undervalued, and how much of it can I afford to buy?" The average person watches the news for signals that it is safe to invest again. The wealth-building person has already set price targets, chosen asset classes, and built a cash reserve specifically for this moment. One is playing defense permanently. The other understands that recessions are simply sales events, the biggest, most predictable sales events in the economic calendar. Here is the single reframe that changes everything. Stop thinking about a recession as a threat to survive and start thinking about it as a scheduled event to prepare for. It is coming. It always comes. The only question is whether you will be liquid when it arrives. The people who get rich in downturns did not get lucky. They got ready. They treated the years of prosperity not as a time to spend more, but as a time to build the war chest. When everyone around them was buying bigger houses and nicer cars, they were quietly accumulating the one thing that recessions reward above everything else: optionality. Principle 1. Build your recession war chest before the recession arrives. This means maintaining a dedicated pool of investable capital that you do not touch during good times. Not an emergency fund, you need that separately. This is offensive capital. Financial advisors often say 3 to 6 months of expenses is enough. For recession positioning, the target is different. You want 12 to 24 months of living expenses in cash or short-term treasuries, specifically earmarked for deployment when asset prices collapse. This is not money sitting idle. It is a loaded weapon waiting for the right target. Principle 2. Build your target list now, not during the panic. Every serious investor who profited from past crashes had a predetermined list of assets they wanted to own at a specific price. Not vague ideas, actual tickers, actual properties, actual businesses. They studied these targets during calm markets. They understood the fundamentals. So when the price dropped to their threshold, there was no deliberation. There was no fear. There was only execution. Your list should include index funds, individual stocks and sectors that historically recover fastest, and if applicable, distressed real estate in markets where you have local knowledge. Principle 3. Recession-proof your income before the recession hits. This is the most overlooked piece. You cannot deploy offensive capital if a job loss forces you to spend it on living expenses. The goal is to reduce your vulnerability to a single income source. That might mean building a secondary income stream, freelance work, consulting, a small online business. It might mean acquiring skills that make you genuinely hard to replace. Or it might mean cutting fixed expenses so dramatically that your cash reserve extends further. Optionality in investing only works if your personal finances can survive the storm independently. Now here's where most people go wrong even when they understand the principles. Mistake 1. They start executing too early and run out of powder. Asset prices rarely bottom in the first wave of selling. Patient capital waits for genuine capitulation when even the optimists have given up. Mistake 2. They concentrate everything into one bet. Diversification across asset classes during a crash is not timidity, it is risk management. Mistake 3. They follow the news cycle for timing signals. The news lags reality by weeks. By the time the headline says the bottom is in, the bottom has already been and gone. Use price, not headlines. Here's what you do starting this week. First, calculate your current liquid investable capital, cash and equivalents you could deploy without touching your emergency fund. Write that number down. Second, over the next 30 days, research 3 to 5 specific assets you would buy if they dropped 40% from today. Study their fundamentals. Set your price triggers now. Third, audit your monthly expenses this month and identify the 2 largest discretionary items that could become cash for your war chest. Recessions do not give 2 weeks' notice. The time to build the position is always before the headlines tell you to. Here's the question I want to leave you with, and I genuinely want your answer in the comments. Most people intellectually agree with everything you just heard. They understand the cycle, they know what they should do. But when the actual crash comes, when their portfolio is down 40%, unemployment is rising, and every news channel is predicting total economic collapse, almost nobody executes the plan. So tell me, what do you think is the real reason that knowledge alone is never enough? And what would it actually take for you to buy when everything around you is on fire?